Speaking about preparing a target for public company readiness. So first, why don't we just go through and give bios and backgrounds of the panelists. So I'm David Briones. I'm the founder of Brio Financial. We're a management consulting firm, outsource, IPO readiness, audit preparedness, valuation firm. Represent about 40 NASDAQ, NYSE operating companies, another 35, 40 SPACs, and have been doing SPACs for about 15 years.
Hello, my name is Natalie Verbanek. I'm from CBIZ. We're a national accounting and consulting firm. We're one of the leaders in the SPAC space, and I'm an audit partner at CBIZ.
Chris Brandis, I'm with CFGI. We're an accounting advisory firm helping support the office of the CFO, and we've been working with SPACs and built a practice that's cross-border as well as heavily domestic here.
Hi, Adam Burkaw. I'm a partner at Ellenhoff Grossman & Scholl and one of the co-heads of our SPAC group. Over the last 3 years, we've done more SPAC IPOs than anybody in the legal world. We like to represent from the SPAC IPO through to D-SPAC, and then if we're lucky enough for the target company to decide we were good at our job, to continue to represent the target company and deal with its governance and reporting thereafter.
Mach Millette. I'm an insurance broker at Lockton. I've been an insurance broker for about 15 years. I oversee our SPAC and D-SPAC practice and go public practice along with some of my colleagues who are here. Over time, since 2017, we've done the D&O insurance for 365 plus SPAC IPOs and over 165 D-SPACs. The reason I work in this space is because I used to be a securities litigator at Skadden Arps and used to handle some D-SPAC litigation back in the day. So when the boom rolled around, I knew how to spell the word SPAC. So here I am.
Awesome. So I'm going to start out and just do a couple high-level questions just for all of the panelists to kind of discuss it first, then we're going to get a little bit granular. So as a company or as a SPAC is going through the D-SPAC process, panelists, give me a couple examples of just common delays during that readiness and D-SPAC process that you see.
By a huge margin, my colleagues are better placed to talk about this than I am, but by a huge margin, how ready the target's financial statements are. It can generally be a surprise to targets that they have to, number one, that they have to prepare PCAOB financial statements, but number two, and more importantly, just how difficult that actually is. And generally speaking, the better, bigger, and longer the business has existed, the harder it is to create those financial statements because you've got something complicated that's been put together over a long period of time, maybe without thinking that you were ever going to go public.
I'm proud to say we've never slowed down a D-SPAC. Insurance is always put together 4 to 6 weeks out from the D-SPAC. We are very focused on that. We've had clients come to us with a week to go before a D-SPAC, and we've built an insurance program from scratch. We've also taken over programs at the last minute from other brokers and rebuilt them to be more efficient and more effective. So we sit back and watch the delays and wait, and sometimes it takes a while, but never our fault yet. We promise that.
I was going to say the biggest part of the process are the financial statements that do take the longest, and the companies really underestimate the amount of time that it takes, especially as you mentioned, the longer the company has been in existence, the more complex the transactions are. Getting ahead of the timeline is a recommendation.
Yeah, if most companies are starting off with a very sufficient process as a private business, but the demands of being audited to the public standards as well as preparing the financial statements under that timeline often companies will struggle with that in the current period as well as sort of that look-back period and making sure they have financial statements for a 2-year period to include in the filings.
And I think the only other thing worth mentioning, just from the legal point aside that we often deal with, is people often underestimate how long it will take to put together a successful pipe. Obviously, in a perfect world, you would sign up your pipe at the same time you sign your business combination agreement, but oftentimes we see companies that need to delay that, and so the pipe signing it up becomes a closing condition rather than something that's done at the signing. And, especially if you have a minimum cash condition in your business combination agreement, it can take time.
Awesome. Continuing with just sort of high level, when we talk about readiness, you hear IPO readiness, D-SPAC readiness. just from a legal, from an insurance, and from a financial accounting perspective, what do you consider priorities as it relates to the readiness during a DSPAC?
Well, I'll start it off on the financial statement side. If a company already knows that there's going to be some sort of inkling of a potential transaction, they should start, even if they don't think it's going to happen or it might be a year or two down the line, they're going to need it. They should start it in advance. They should hire, as everyone's aware or maybe not aware, auditors are not allowed to prepare financial statements or assist, especially to do a PCOB audit. So they have to get someone in, like yourself or CFGI, financial consultant, in order to prepare the financial statements and get the audit package ready for us auditors so that we can audit it properly.
Yeah. The Navy SEALs saying, I believe, is smooth is fast. So understanding kind of where your business is, the readiness assessment that we often talk about is just public company readiness, because where we're focused most of the time is on the actual filings of the S4, F4 to get through the SEC process and complete the DSPAC merger. But as a target business, you really need to be prepared for that life day one as a public business. So having that lens, not just the short term of getting through the transaction, which is incredibly important and a milestone, but being successful in that period after it in your first few Qs and Ks.
So I would say on my end there are two things. One is the easy one, which is preparing your corporate governance. Any law firm you hire, please hire us. We'll prepare your corporate governance docs, which include audit committee charter, compensation committee charter. If you have a nominations committee, that charter, your policies that are required, policies that we recommend but you don't necessarily need. Those tend to be more form based. I think one of the things that catches people by surprise, and it's just a recommendation to someone that's completing a DSPAC, is that when you close your DSPAC, very suddenly the SPAC is going to go away, the sponsor is going to go away, and there are an enormous number of filings that have to happen within a month, like right after. So my suggestion would be to, if you have counsel, to have them start working on that before the DSPAC closes. So to give you an idea on that, you either have, you have to file what's called a Super 8K or a Super 20F, which if your financials have gone stale in the meantime, means that you're going to have to update your financials, which is a huge deal, and it's due within 4 business days of closing. So in the middle of the mayhem of closing it, you have to prepare a very significant, pretty long filing that is going to conclude your first set of updated financial statements as a public company. Then you also have Form 3s and Form 4s that announce what people own. You have 13Ds that announce what your major stockholders own. And before you know it, you're going to have to file a resale registration statement, usually within 30 days of closing. Again, that's a long form registration statement. So all these things happen very, very quickly, and you need to be ready for them. And ideally, you'd have your lawyers start working on it, 2, 3, 4 weeks before closing.
So I'm going to ask by a show of hands, how many of you know that in the business combination agreement there is an indemnification provision? How many of you know that there's an insurance provision? I don't see very many on the second one. So there is an insurance provision in the business combination agreement, and it shouldn't just be run by your counsel, it should be run by an insurance broker who knows what's going on in the DSPAC D&O insurance space at the time that you are thinking about going public. Because there's a lot of language in that provision these days that doesn't make a lot of sense in terms of how these are being structured now. From an insurance perspective, readiness means knowing what insurance exists now at the SPAC, what insurance exists at the private company, and we're not just talking about D&O insurance. As we're doing more transactions with true operating companies who have real activities and real business, and it's not just a pipe dream, you need to make sure, do insurance due diligence. Make sure that that company has cyber liability insurance, D&O insurance, other types of insurance that covers their risk in their industry. Figure out if you're the target what the SPAC has in place, because all of this is going to matter, because it's going to filter into how much is insurance going to cost at the DSPAC. How much is public company D&O for an operating company that's going through a DSPAC going to cost? That should be forecast around the time of the BCA. That is quite doable.
Awesome, thank you. So for the private companies out there that are really attending this conference to potentially meet underwriters, to potentially meet SPACs that are looking for targets, Natalie, what, as well as Chris, what should a private company do to prepare and be an attractive target for an acquirer?
So a couple things are, we keep on talking about the financial statements, but they are the key part of it. They need to get that ahead of time. And one thing that, speaking on the sponsor side, when they're looking for a target, one of the items they are looking for is if they have an audit already done or how quickly can it be done, because the SPAC doesn't have enough time. They have a timeline, there's a countdown. It's more attractive if they already have had the audits done or almost finished. If a sponsor and a SPAC come to a target and they haven't even started the process, they're already behind the game. Because at a minimum, I can say, a basic company can take a 2-year audit, opening balance sheet, about 6 to 8 weeks, and plus, depending on if there's complex stuff. So right there and then, if you're talking to somebody, that might be a deal breaker and they might walk away. So if you know you're going to get some sort of fundraising, doesn't matter if it's a SPAC or a traditional IPO or even a bank line, companies should have financial statements audited and they should have them almost ready to go because that will be one of the items that is most attractive for a SPAC.
Yeah, I think having a conversation with the auditors, CBIZ here, as soon as you start to embark on that potential for a public listing or a SPAC transaction is really important. As a private business, your audit firm may not be willing to go on that journey with you. They may not have a PCAOB registered audit partner to sign the opinion. They may not want to take on the risk of a SPAC transaction or a public listing. So there's a lot of reasons that are very valid why the audit firm may switch during this process, and that sort of resets the clock. Whereas maybe on the mindset of the timeline with a current auditor would be much faster, starting from scratch to go through and do an opening balance sheet audit, and potentially 2 years can take quite a bit of time. So getting on the same page with your audit firm, understanding what that plan is going to be. The audit firms will also help sort of guide around where your focus and attention needs to be on creating audit documentation for them and accounting documentation for the company. Having contemporaneous documentation is really important on key transactions. It's going to give kind of a lot of comfort to the CFO and the business and the board, as well as the SPAC partners, that you're going to be prepared to get through that transaction timely.
Yeah, I see it all the time. In my world, where I'll have an underwriter or a SPAC reach out to me and basically say, hey, we've got this great target. They have their tax returns prepped. They have a set of QuickBooks, and they have a CFO that 27 years ago worked at PwC for a year. Hear it all the time. We dig under the hood, and they've failed to be on the accrual basis. They don't have GAAP-ready financial statements. They've completely failed to account for any non-cash transactions. Their entire cap table is unaccounted for. They have convertible instruments that have all kinds of goodies baked into them. So, there's a lot of accounting that needs to be done with things like that. So, it's always good to having a professional assess you and take a look under the hood to see what really needs to be done. So going with that, Adam, when must parties decide on post-closing directors and officers? So we've gone through the process now of a SPAC identifying a potential target, and they're preparing from a legal end. What needs to be done?
Right. So usually the private company is going to know who its CEO is. It'll probably stay the same. Who its COO and various other officers are, they'll probably stay the same. What we tend to see, though, is that either the private company doesn't have a CFO, or they have a CFO that's not prepared to be a CFO of a public company, which is a whole different ballgame than being a CFO of a private company. And so the question that arises most often is, when does that CFO need to be in place? Because people want to run big searches to find the right person for their business. And the answer, the first thing that's worth noting is that if you're a NASDAQ-listed company, you must have a CFO. It is not optional. They will not grant you approval to list. The NYSE, technically, you don't require it, but the reality is you essentially have to have one. It's very hard to get out of it, and it's certainly in your best interest to have one. And so that can happen actually quite a bit later than you might think. You can actually take your registration and statement effective without having a CFO. You'll have to decide it before closing and put out a proxy supplement. So the SPAC stockholders can see who the CFO is going to be. They can read their bio, and then that will be the CFO at closing. So it can be later. In the same way, the compensation of those people. In an ideal world, the compensation committee would hire a compensation consultant after the DSPAC and have that compensation consultant really drive what their what the officer's economics are going to be. In reality, that's almost always impossible because those people tend to want to know what they're going to make at the closing of the DSPAC. They're not really willing to wait a month or two to see where the compensation consultant is going to come out. So the parties just kind of need to get comfortable with that and perhaps set a shorter time span where their compensation can be reevaluated. On the director's side, best practice is easily to have the compensation committee wait till post-closing to decide what independent directors are going to get paid, hire a compensation consultant, have the compensation committee hopefully follow that consultant's guidance on what the independent directors should make. The alternative is to hire that compensation committee consultant prior to closing and then have the comp committee ratify the decisions that were made at closing. That is okay, it is defensible, but it's not best practice. And so that's kind of our guidance. And on the independent directors front, it's exactly the same thing as the CFO. It's obviously for the best. The sooner you can get them narrowed down and in your registration statement, the better. But if it comes to it, I just closed a DSPAC a month ago where they didn't know their final director up until about 15 days before closing. We put out a proxy supplement, and it's fine if you can make it work. But it always has to be before closing.
Awesome. Mark, what does a SPAC need to think about concerning insurance as they approach a business combination agreement?
Well, so I mentioned earlier the discussion about due diligence. So if it's a private transaction with a private equity firm or a strategic, typically you would do extensive insurance due diligence on the company that you're acquiring. As a SPAC, you should be doing the same thing with a target company. You should be doing that insurance due diligence. And if the answer is, we don't have any insurance, and we find that plenty of times with SPAC targets, by the way, that's fine. You just have to deal with that in advance of the DSPAC close. So I think that's the biggest thing, is actually conduct insurance due diligence. And as I said earlier, it's becoming more important as you have companies that are actually operating companies that have real financials, have real operations, what have you.
I'm just curious, when you go through that, like, what percentage of companies have actually had that assessment done?
How many companies actually do the due diligence on the insurance? Or how
Prior
many
to,
actually have insurance?
like, before they show up at your doorstep.
There is a minority of SPAC sponsors who do due diligence on every single transaction. It is a minority. I think it should be a much higher percentage personally, but we do have certain SPAC sponsor teams, repeat SPAC sponsor teams who do it every single time.
Interesting.
And it's, from my perspective, it's advisable. It's typically not particularly expensive. It's usually a pretty quick exercise because the insurance is fairly straightforward in most of these situations.
Awesome. Natalie and Chris, what issues do SPACs encounter when selecting a target, and what items to consider before signing a letter of intent with them?
So, in addition to the financial statements, the companies have to think about internal controls. I know that's a thing that's far from their mind, but the sooner that they also start working on their internal control processes, because the SPACs and the sponsors want companies that are well developed, properly accounted for, and they have a 1-year waiting period. They don't have to provide management assessment immediately, but that time goes by quickly, so they shouldn't be waiting for that. So they should do that beforehand. And in addition, another thing is, and I think somebody touched upon it, is having the right officers already on board, because being a public company is another business of itself on top of running your operations. So selecting a good CFO, controller, having somebody in place that can able to prepare, speak in front of investors and presentations is key because they are going to be a public company. So in addition to having the financial statements and controls, the proper management in place is something that is not thought about quickly. And the process does go by quickly once the de-SPAC happens, that they need to have that on board because, again, they're not a private company anymore. They're responding to and complying with the SEC, exchange rules, and the public market.
Yeah, thinking kind of within the lens of financial reporting and accounting, I think what we refer to as finance effectiveness, ensuring that the business can close its books correctly and timely, is somewhat overlooked at times because they will have an audit report as a private business, but the timelines may be for a debt arrangement that they have, and it's due 6 months after the balance sheet date in June, right around now. A lot of times that's the case, and there's a lot of confidence then in being able to get through an audit, and people will have that confidence. But pulling that forward by almost 4 months, 4.5 months, is a real challenge. And there's a lot of time that needs to go into that, whether that's systems or just personnel and attention. Going through the de-SPAC process is very demanding, especially on CFOs or others, that directing the resources in order to accomplish that and pull all the close process and financial reporting forward is in addition to and really onerous for the business. Other thing I might say is around data governance, which we've seen a number of times where companies have FP&A or some other component. They've got some really good financial metrics in comparison to competitors, but they realize going down that path that their financial metrics are not very consistently defined within the business. So one legal entity may define a certain date in one way and the other defines it as another. An example of this, it is an insurance company that we were working with where a certain date was defined as the first of the month and another section of the business defined it as the date an insurance policy was signed. And then it really gave them difficulty in going through and organizing some of their internal metrics that they were planning to present publicly. So understanding the data governance and what might go into correcting or sort of making them public company ready.
Interesting. One of Adam's partners and I spoke last month at an event, and he made a really interesting comment about delays in financial statements. And his comment was, companies that are going through that first S4 filing spend a lot of time, there's delays getting it done, but they don't necessarily realize that when the comments come in, they need to update their financial statements. And for what took to get through 2 year-end financials could potentially take just as long getting through quarter-end closes, and he had experienced multiple delays in that too. So it's not just getting through your audits, you've got ongoing reporting requirements even before you're public. So just found that interesting that we were speaking before on that. Adam, what committees is a U.S. public company required to have, and what are recommended?
Yep. So you have to have an audit committee and you have to have a compensation committee. And under New York Stock Exchange, if you're an NYSE company, you have to have a nominations committee. If you're a NASDAQ company, you are not required to have a nominations committee, but the truth is if you want to adopt best practices, you should have a nominations committee. Most SPACs don't, for obvious reasons. They're never going to appoint a new director. And so really you need those three committees, and then you need the charters behind them. And then just to expand on what I was saying earlier on the policies, what you need to have, you must have an insider trading policy, you must have a clawback policy. NASDAQ and the New York Stock Exchange require you to have a code of ethics, and the New York Stock Exchange requires you to have corporate governance guidelines. I've never seen a public company that doesn't have a related party transaction policy. That would be borderline insane. You need to have, we often recommend that folks adopt whistleblower policies, Reg FD policies. Reg FD policies control how fast and how you make your material information public to cleanse the market of inside information. So things of that, all those things need to happen in conjunction. They need to be day one items that are adopted on the closing date.
Thank you. Mark, how can teams determine the best D&O insurance structure, appropriate limits, et cetera, for a de-SPAC?
So I think it's important to back up a little bit. This is not an insurance exercise. This is a risk management exercise. So you should really be talking to your advisors about what is the actual litigation environment right now for SPACs and de-SPACs as you go through the process. How does the litigation actually play out? How active is the SEC on the enforcement side right now, what have you? A lot of teams that we meet on the de-SPAC target side, their basic risk assessment is, I've been told this is risky, and it doesn't go much beyond that. I think a full-fledged understanding of how little litigation there actually is in relation to the de-SPAC itself at this point in time is really important. So my colleague Derek armed me with some stats. Over the last 12 months, the cases that have been filed against companies that had previously gone through a de-SPAC, the lag from de-SPAC close to litigation was 1,453 days on average, 1,419 median. That means those cases are not de-SPAC litigation. Those cases are public company litigation against existing public companies who are doing restatements or having other issues. So the perception that de-SPACs are super risky has never been true. The market certainly went in that direction from the D&O perspective for a while in 2020 and 2021, unfortunately. It has now recovered back to where premiums have come way down and a realization that the litigation environment's not that bad. So a de-SPAC team really needs to understand what the true risk is, what kinds of cases have arisen, where have these issues come from, why have they happened? Because a lot of them are very fact specific and come from very specific behavior that, yes, you should avoid, for sure, in a lot of these situations. The plaintiff's attorney's bar has become largely disinterested in de-SPACs because there's often a very low public float. So they have no interest, even if there is a stock drop, in bringing a case because their piece of the damages is not large enough to chase. The SEC, with their proposed rules, drove enough changes in how SPACs were doing these deals so that they have become much less active. And the Delaware Chancery Court, although initially inviting derivative claims to come to Delaware, quickly realized that they did not want them at that level, and so they issued some decisions really slowing that down as well. So we have a situation now where risk is not what it used to be or what it used to be perceived as, and teams really understand this. Even over the long term, de-SPACs have never been more risky than a traditional IPO from a litigation rate. About 16 to 17% of all transactions over the full history have yielded a piece of litigation. 1 out of every 6 or 7, same as a traditional IPO.
If I could just expand on that from a legal perspective, because it does have to do with preparing on the SPAC side for closing your de-SPAC and dealing with the potential liabilities that may come up if your target doesn't perform the way you hope it does. So agree with your summary of reduced litigation, but something that the Delaware courts have been focused on is the involvement of your independent directors in the process of selecting your target and signing your LOI. And so throughout, on the kind of ironically on the SPAC side of considering how to get ready to be a public company on the target side, you need to be focused on taking minutes that show that your independent directors have been heavily involved in, they've been kept up to date, ideally by monthly meetings that explain, that where the CEO walks through the different targets, the status of the negotiations, possible terms. They ask questions, they do their own research, they are as involved as they are willing to be, and you keep notes throughout. And one of the practice points that has actually changed for us in the last year, whereas, before the last year, it was very unusual, or at least maybe not very, but it was unusual for boards of directors to approve the LOI for the de-SPAC. And the reason for that is simple. It's non-binding. You can just walk away. But the problem with that is almost all of the most significant terms of the de-SPAC are decided at the LOI stage, and they mostly stay the same. So it is, we view it as an absolute requirement that all SPAC boards of directors approve the LOI. Obviously approve the BCA, and frankly, if you're doing a pipe that's on a separate timeline, they approve the terms of the pipe. They are as involved as they are willing to be, and you're keeping a record of that involvement throughout.
Thank you. Natalie and Chris, finally, what are the biggest readiness gaps you see in private companies entering a SPAC transaction?
So, the main thing is they obviously you want to hire a great team of advisors, but on top of that, I think the gap is they think a lot of private companies that when they hire the advisors, hands off, it should go work on its own. They need to be heavily involved. I think that's one of the biggest things I see where management is hands off and thinks everybody else will do everything for them. But management needs to be involved. They need to review things. They need to verify things. They need to communicate. They need their hands in. I think that's one of the things I do see with private companies because they say, all right, we're paying these people. I got an attorney, I got the accountants, I got the financial advisors. Everything's going to happen by itself. It doesn't. They need, my most successful closings are where the management is more sophisticated, more involved, hires the right team. But again, I think it's the involvement and having, the expertise. Don't have to have a significant amount. You can have the basics of being and preparing financial statements and understanding them, but they need to be involved and communicate with all of their parties in order to get it to the finish line.
Yeah, I think it's an excellent point, and the communication there amongst the working group, along with management as the lead. You can hear from our commentary here how we cover a number of different topics and all have a slightly different point of view around how a situation should be approached. And what's most important is that everyone here is on the same page and talking to each other in order to sort of accomplish that, so that as terms may be changing or there's negotiations we just heard around how to structure a deal that's right for two individual companies, a SPAC and a target. But as you're working through some of those other sort of changes within the PCA or some of those terms and how it's going to fit to be right, making sure that the auditors are kept abreast and the accountants as well as from a risk side, if you're going through and assessing cybersecurity risk or some other component, and changes need to be made to the business to really maximize the risk profile, and then how that insurance product can be right for the business. Making sure that that's consistently known, and the working group is a cohesive team supporting management.
Adam, and you finally, what public SEC filings will be required, and what others should be taken? What actions should be taken?
So I touched on this before, but what's really important is just that the target company know, and the SPAC know to the extent they can be helpful, is that when you close your D-SPAC, there is a whirlwind of activity that happens. There is no break. You are immediately filing a large Super AK, or if you're a foreign company, a Super 20F. Those are large documents, and if they have to contain new financial statements because your financial statements went stale, it's brutal to get that in and to get that done in 4 business days. You're going to have to prepare a resale registration statement within 30 days. You're going to have to file, Schedule 13Ds for people who hold more than 5%. For all your officers and directors, you're going to have to get your Section 16 filings done. Those are Form 3s and Form 4s. There's just a whirlwind, and the sooner you can prepare for that, even while you're in the whirlwind of trying to close your D-SPAC, the better.
Great. And Mark, finally, for you, if you had to give one piece of advice to either targets or the SPAC sponsor that are in the audience today as it relates to risk and D&O insurance, what would you give them?
I would say really get to know the risk. Really talk to some folks who can explain to you what the historical litigation landscape looks like, what the current marketplace for D&O insurance looks like, who the real players are, what we're seeing on a day-to-day basis in the marketplace. So we're out there all day, every day on the SPAC side and the D-SPAC side. We can tell you what your SPAC will cost for D&O insurance a month from now, what your D-SPAC program should look like from a size perspective, a structure perspective, what have you. Get to know what you're going to have to deal with. Don't wait. A lot of folks want to wait until they file the next S4 after comments or what have you. You don't need to wait. You can get started on it. You can get it pretty well in place, and if there are tweaks, it's fine. Get moving on the D&O insurance, and it will sit alongside the rest of the transaction, and it will never get in the way.
Awesome. Any other final remarks from everybody before we open up to questions? Any questions for the audience? So the question's, what's the length of time from finding a target for a D-SPAC to close, the start of launching a SPAC to the IPO?
Right. So from a legal point of view, I can tell you it generally takes 2 to 3 months to do the IPO. Right now, it might be even a little faster than that because the SEC is not tending to review SPAC registration statements. It is. I think we've really touched on this, but it is. Most SPACs have 2 years, right? In their registration statement, they give themselves 2 years. NASDAQ and the NYSE permit 3 years, so you can extend to 3 years. But really, in an ideal world, you'd have 2 years to close after closing. But the problem is, you don't. Beyond that, what's going to matter the most in terms of timing isn't even the preparation of the registration statement; it's the preparation of the financial statements.
Are you asking how long it takes from the SPAC IPO typically to close the D-SPAC?
I have the companies. All I need is the budget. So
Is the what?
from the point I have the company, I already have the companies. I need the budget. So therefore, how long does it take you to get the money once I go to SPAC?
So it sounds like you're looking that you have an operating private company that would like to raise capital via D-SPAC. So it's a loaded question. Are there financial statement audits? You know, are they audit ready? So it really depends. I think, you know, Adam would say it's really going to dictate on the audit because the legals in this room, they can move as quick as the company. It really comes down to the financial disclosures and controls of the company and the policies and how quickly the audits can get done. Would you agree with that?
Speaking from experience, if you have your financial statements ready, I won't sleep for 4 days if you want it filed in 4 days. It just is what it is. It's the financial statements and getting the audit done is the thing that the people who won't sleep until it's done just are stuck waiting on in the vast majority of the time.
Just grab Chris or I after and we'll divvy up your work. Any other questions? Please.
To what extent are you helping your clients with their guidance philosophy? To what extent are you helping your clients with their guidance philosophy once they become public?
Once they become public. Yeah, at that point, obviously, as you know, things change. It depends on the company. So I'll give you 2 examples, both that I've dealt with in the last 3 months. I've got a Horizon Quantum. What's the name of the company? It's fine. It's public. I've got a quantum computing software company, Horizon Quantum, which is it's a great company. I love them.
We agree.
I would agree.
Yeah, hey, that's good. With quantum computing being where it is and adoption, their CEO has decided, frankly, at our urging, don't put out guidance. Don't do it. In contrast, I've got a critical metals manufacturer who has a huge order book, right, and a huge backlog that has line of sight to their revenue, for the next 2 years. And so in that situation, if you're comfortable doing that and you feel good about it, absolutely. The key thing is, wait till you're a public company if you can. If you can't, I'm sure other people are going to talk about this in several presentations, the use of projections in the context of a D-SPAC, but we're talking afterwards. Obviously you have the safe harbor at that point after you go public. So if, with cautionary language, you should be covered as long as it's not truly ridiculous. So it's really company driven.
Thank you.
Any others out there? Nope. All right. Thanks everybody for listening. Nicely done.